I just finished up a meeting with one of my property managers and I instructed him to lower the rent price on some of my properties because of what's happening in the economy. Let me explain. The way real estate investing works is you buy property. For me, it's single family homes and apartment complexes, and then you rent them out to other people who pay rent. Now, I don't manage these properties myself. I've hired some property managers to do that work for me, and I have regular meetings with my property managers to discuss what's going on. And in my most recent meeting with one of my property managers, he was talking to me about this property. We're leasing it out for $1,400 a month, and he was telling me that this lease is about to come due, and we're discussing what we want to do with it. He was saying, should we increase the rent or whatever? And I said, no, let's take the rent down, and then let's have the tenant sign a 2-year lease. He thought that was a weird thing to say. Why would you want to bring the rents down? It doesn't really make much sense. And I said, well, I'm concerned about what's going on in the economy. And I think the next couple of years are going to create pain in the economy. And for me, I'd rather have a safe, secure, and stable tenant paying rent than have a vacancy and then have to deal with a vacancy when you're in a rougher part of the economy. So for me, I like stability. And even if I have to take a little bit of a discount on rent to create that stability for me, especially for the next couple of years, I would be willing to do that. The property manager said okay, and the tenant was very happy. The reason why I'm saying this is because I want you to understand the current state of finances in the real estate game, because over the last number of years, real estate prices have gone up quite a bit. Now, when I invest in real estate, I don't really care about real estate prices because I'm investing for cash flow. I'm not trying to buy a property to sell it for a profit. My goal is to buy a property and hold on to it for the cash flow. But real estate prices have gone up. What does that mean? Well, when your real estate prices have gone up and values go up, that means that your real estate taxes go up as well. So my property taxes have gone up. And in addition, that means you're also insuring a more expensive property. So my real estate insurance prices have also gone up. And then the cost of labor and maintenance has also gone up, not to mention the cost of materials. So my maintenance and materials cost has also gone up. So the expenses side of managing and owning rental properties has gone up. And now we're starting to see this little shift. Yes, you are seeing rental prices still grow in some areas, but you're starting to see this big slowdown in rental prices. Why? Because we're seeing a slowdown happen in the economy. Why? Because 1, we have high inflation. 2, we have an increase in interest rates. And 3, we're also seeing a slowdown in the economy. All these things are starting to put more pressure on different sectors of the economy. And for me, I want to be more proactive. Now, does this mean that I'm going to be right, or am I milking it or whatever? I don't know. This is just a way for me to create stability because I like stability. I want consistent cash flow, and I see the red flags that are happening in the economy right now. Now, if everything blows over, then fine. In 2 years, then we can raise the rents and go back to normal. But if we start to see a lot of problems in the next couple of years, at least I can create stability with stable cash flows. I was recently sitting down with Tom Bilyeu of the Impact Theory podcast, and we were talking about what he calls the triangle of doom. And essentially what that means is we have these 3 things coming together right now, kind of creating this perfect storm in our economy. Number 1, we still have very high inflation. Inflation has come off its highs, but we're still closer to our peak inflation than we are to our goal inflation. The Federal Reserve Bank wants to bring inflation down to 2%, and we're still closer to our high of 9.1% or so than we are to the 2% target. In addition to that, we have interest rates rising. Interest rates are growing very quickly, and we've seen the impacts of interest rates now finally. Where have we seen these impacts? Well, we saw the Silicon Valley Bank collapse, we saw the Signature Bank collapse, we saw the Credit Suisse emergency takeover, and we're seeing all the other pressure in the banking sector. So the higher interest rates are clearly showing their effect in the banking sector, not to mention that the higher interest rates also make buying a home less affordable. Then, in addition to that, we have the slowing economy. Where do we see this? Well, you see layoffs happening across different sectors of the economy. We've seen some bankruptcies. So we're seeing these 3 different things happen. But the real concern and issue here is this inflation problem has not gone away. And in order to bring this inflation down, the Fed has to keep raising interest rates. And the Fed is having pressure to no longer raise interest rates because of what's happening here. But the Federal Reserve Bank keeps saying that they need to bring this down. And while they're trying to bring this down, this is continuing to hurt the economy. Why? Because high inflation brings the economy down. High interest rates also bring the economy down. Why is the Fed working to raise interest rates? As a way to cool this down. But in order to cool this down, you got to cause more pain here. So what it seems like to me is that this economic pain seems like an inevitable consequence of this to fight this. Now, of course, look, this is just my opinion. I could be wrong. I'm just a random guy on YouTube, which is why you got to understand that investing has risks. You're never guaranteed to make money when you invest. You need to always do your own due diligence and never blindly trust a random guy on YouTube. But to me, when I look at these different factors, you can kind of see the concerns. And so for me, I want to see how do I protect my money, and the way that I do that is one, continue to stabilize my cash flows, invest money strategically, and put money aside. That way I can take advantage of opportunities that might come my way. What does that mean? Well, anytime we have seen economic pain in the past, it has created opportunities. Meaning, it creates the opportunity for a savvy investor to go out and buy good assets at a discounted price. Because now, if you've been watching this channel, you know that investing your money is the secret to becoming wealthy. Well, when you have economic pain, these investments, these assets go on sale, meaning for the same amount of dollars, you can buy more assets. So when you have this type of economic pain, yes, it is painful, but it also creates opportunities for people who are prepared and financially educated. So for me, it's how can I prepare myself for this potentially happening? Now, if I'm wrong and we don't see any more economic pain, no big deal. It doesn't cost me anything to prepare. Sure, maybe I have to put aside some cash and I sacrifice some nice things today. I don't go out and finance a new truck, but I have that extra cash now to potentially take advantage of things that may happen. If nothing happens, I have a big bank account. If something happens, well, now I have the resources to go out and actually take advantage of the opportunities. Now, of course, we've been keeping you up to date on what's happening, when it's happening with Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, I highly recommend you do so, because every day my team is breaking down what's happening in things like the economy, the stock market, the crypto market, the real estate and housing market, and even the global economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. There are two general ways that I invest my money. I invest my money actively, and then I invest my money passively. Passively means that I am investing my money without touching it. The way that I do this is I have a portfolio of ETFs, which are funds that give me exposure to different stocks in the stock market. So what does that mean? Instead of investing in the Amazon company, I invest in a fund that gives me exposure to the Amazon company and 400 other companies. That's what an ETF is. So I have a portfolio of ETFs, and for me, every Wednesday, I have a system where cash is automatically pulled out of my checking account and invested into this portfolio of ETFs. This happens every week, no matter what's happening, whether the market's up or down. This continues to happen. This is a long-term investing plan, and this is something that I have had happening, and it will continue to happen no matter what's happening in the markets. That is my passive investing strategy. My active investing is now where I'm looking for active investments to make. What does that mean? Well, I invest in startups. If I see a good startup investment opportunity, I will make it. I invest in physical real estate. If I see a good opportunity in the real estate market, I will make it. But again, it has to fit within my investment criteria because I invest for cash flow. So I'm looking for good real estate investment opportunities. If real estate prices come down, then that could create better opportunities for me. And number three, I invest in individual stocks and companies. So if I see the stock market get hit and there are some companies that I want to invest in that get hit, well, then that creates an opportunity for me to come in and invest. See, active investing is more work and it comes with more risk versus passive investing is less work, less risk. Not everybody needs to be an active investor. Not everybody will be a passive investor, but I would say for the majority of people, passive investing is probably a better way to go, because if you want to be an active investor, you have to be willing to do the research, put in the time, and actually care about keeping up with your investments. Because the reason why so many people, for example, the reason why so many people lose money in the stock market, I mean, the majority of people lose money in the stock market, even though the stock market has grown historically over the last century, is because most people don't know how to actually manage their money when they invest it. They throw their money into the next hot stock and hope it's going to rally and then win. You see a correction happen, you panic, you get scared, and you sell, which is why so many people end up losing money in the stock market, and then they hate the idea of investing and then never want to do it, when in reality, if you just know how to invest your money the right way and you have a long-term investment strategy, you can make way more money with way less work. Growing up, I had no idea what real estate investing was. I had no real estate investors in my family. I was never exposed to real estate investing, but then I read this little book called Rich Dad, Poor Dad by Robert Kiyosaki, and in that book, he talked about this thing called real estate investing. And that's when I realized that, oh, I could go out and buy a property, rent